Trade war is not a fear anymore, it's a reality. The US President Donald Trump imposed a 25% import tariff on Canadian and Mexican goods and a 10% tariff on Chinese products, while also saying that the European Union could follow next. In response, Canada, Mexico, and China threatened retaliation, reducing any chances for a quick resolution before import tariffs take effect on Tuesday. Well, as trade risks are increasing, the focus will also fall on the economic calendar. ISM business PMI figures and Nonfarm Payrolls data will be out this week, while in the UK, the central bank is expected to cut interest rates by 25 basis points this Thursday. So at this video, I'm going to break down three major FX pairs: euro dollar, dollar yen, and pound dollar. And let's first start with euro dollar, which opened the week with a large negative gap, falling as low as 1.02 earlier today. That's close to January's low of 1.0176. The 61.8% Fibonacci retracement of the 2022 and 2023 uplift is around the same region, so that creates a hope for a rebound. However, if we look at the technical indicators, you can see that the RSI is still sloping downwards. Likewise, the stochastic oscillator is falling lower, and although it's very close to its 20 oversold mark, oversold conditions have yet to be confirmed. Perhaps for that we need a rebound, or at least we need the price to hold above 1.02 and probably above the 1.117 number, where this falling line from February 2024 is located. If we fail to hold above this region, then the decline could continue towards this short-term support line at 1.0104, and then lower than that, the case of parity could materialize. And if that also fails to hold, probably the next target could be the 0.99 number. Now, in the event of an upside surprise, of an upside break, we could approach the 1.0335 territory, where this resistance trend line is placed. Above that, the 50% Fibonacci mark is at 1.04 and closer to the 50-day moving average. So this could add some pressure before a tougher battle takes place, somewhere between 1.0475 and 1.04, which the price failed to overcome last week. If we successfully break this wall, then the price could accelerate towards the 38.2% Fibonacci of 1.0611. Stronger than expected Eurozone CPI inflation data failed to help the price to pivot higher earlier today. Perhaps that suggests that traders are probably concerned about potential import tariffs coming from the US. Turning to dollar yen now, import tariffs helped the US dollar to gain significant momentum, but as regards dollar yen, the pair couldn't gain moderately today. It couldn't surpass the 155.65 zone either, and it's currently trading with slightly negative. So negative risks haven't really evaporated in this market, and this is also reflected in the technical indicators. We can see that the RSI has yet to rise above its 50 neutral mark, and the price itself is still below its 20 and 50-day exponential moving averages. So there is risk for additional losses. Nevertheless, if you look at the price, this is currently trading around the upper band of the Ichimoku cloud, which acted as support last week. The 23.6% Fibonacci retracement of this uplift over here is also nearby at 154.25. So as long as we hold here, there is hope for a rebound. If not, then the focus could fall towards the 153.30 region, where the lower band of the Ichimoku cloud is placed. Lower than that, the next support could come around the 200-day exponential moving average at 152.17, while the 38.2% Fibonacci mark of 151.50 could also come in sight. Failure to pivot here could trigger a fast decline, probably towards the 50% Fibonacci of 149.13. Now looking to the upside, what we need here is a break above 155.65 to continue towards the next barrier, 157.15. Successful break higher here could then take us up to 158.35, where this longer term resistance line coming from July 2024 is placed. So what could help dollar yen to gain extra positive momentum and break key boundaries? Probably stronger than expected Nonfarm Payrolls report and improving business sentiment as probably reflected from the ISM business PMI figures could provide some extra bullish fuel to this pair. And finally, looking at pound dollar, pound dollar also opened with a negative gap at around 1.2250. However, its losses have been relatively limited compared to those in euro dollar and Aussie dollar. And as we can see, the price is still trying to hold above this short-term ascending trend line at 1.2275. So although the technical indicators are sloping downwards and the price has pulled back into this bearish channel, there is still hope for rebound as long as we hold above 1.2275. If that fails to hold, then perhaps we could see a continuation towards the 1.21 and 1.2160 territory, a break of which could take us down to 1.1935, where the lower band of this bearish channel is placed. And if the sell-off continues, then the 1.18 number could be the next target. Now, if we see some recovery here, I would like to see a clear close above 1.2350 before I target again the 1.25 region where the price faced the resistance last week. This is where the 50-day moving average is located, so a close above it could take us, could drive the price towards the 1.26 barrier, and higher than that, a faster rally could follow towards the 200-day moving average, seen slightly below the 1.28 number. So as regards the Bank of England's policy meeting, the central bank is expected to cut interest rates by 25 basis points. This is already priced in, so the focus will probably turn to central bank's guidance and any information about if more additional rate cuts will follow. That could create some extra volatility in pound dollar. So that's everything I wanted to share with you guys. Thank you for watching and wish you have a great trading week. Bye bye for now.